so you want to buy a cemetery. Most people think a cemetery is a quiet business. Sell a piece of land, sell a wooden box, sell a stone, cut the grass, wait for the next funeral. A slow, sad, low-margin trade run by a family that's done it for 3 generations. Sometimes that's true. It's also the cover story. Because underneath the grass is a machine, and the machine has almost nothing to do with burial. So the questions worth answering are these. Why does 1 acre of a cemetery out-earn 1 acre of luxury apartments? Why does the largest operator in North America file paperwork that reads like a mid-sized investment bank? And why is the most valuable thing on the property something the customers are legally forbidden from ever taking back? Start with the price of entry. At the top of the market sits Service Corporation International, ticker SCI, headquartered in Houston. It is the largest death care company on the continent. As of its 2024 annual report, it operated 1,493 funeral homes and 496 cemeteries across 44 states, 8 Canadian provinces, Washington, D.C., and Puerto Rico. Total 2024 revenue, $4.19 billion. That is the giant. You are not buying the giant. The middle of the market is a single suburban cemetery, 40, 60, 100 acres, a chapel, an office. These trade privately, quietly, usually between $2 million and $20 million, depending on how much unsold ground is left. The unsold ground is the whole point. The floor is cheaper than you'd guess. A small, half-full country cemetery with an active license can change hands for a few $100,000. The license is the hard part. You need state approval, a registered trustee for the trust fund, and in most states, proof you've funded that trust before you sell a single grave. Paperwork, waiting time, a bond. Of course, you have that. So the question becomes obvious. Why would anyone in their right mind go through all of this for a business whose entire customer base arrives dead? The answer is simple. You are not in the burial business. You are in the density business and the asset management business, and burial is just the intake form. Here's how it looks in actual dollars. Take 1 acre. An acre is 43,560 square feet. A standard grave, with the walking space between rows, occupies roughly 40 square feet. Do the division, and a single acre holds somewhere between 1,000 and 1,200 graves. That is the number that breaks the old story. Raw land in the right county costs you low 5 figures an acre. Divide that same acre into 1,100 plots and sell them at an average of $3,000 each, and you have generated more than $3 million in gross sales off ground that cost you $10,000. No apartment tower on earth turns dirt into money at that ratio. And you're not done stacking. The industry practice is double depth. 2 burials in 1 plot, 1 vault on top of the other, sold as 2 separate interment rights. The lawn looks the same. The revenue doubles. Then you add cremation niches, where an urn occupies a fraction of a square foot, and the effective density climbs into the tens of thousands per acre. The grass never tells you how many people are underneath it. That's mechanism 1. Now the real engine. By law, a slice of every plot sale must be locked away into a perpetual care fund, sometimes called an endowment care fund, to maintain the grounds forever. The exact cut varies by state, often around 10% or more of the sale price. Here is the part people don't talk about. That money never leaves. The principal cannot be withdrawn. Not by you, not by the family, not ever. What you get is the yield. Think of a bank vault with a mail slot in the door. Deposits go in through the slot. The door never opens again. And you're holding the only key to whatever interest accumulates on top. So you become the asset manager of a fund that can only grow. You invest it in stocks and bonds, and you keep the returns and the management fees year after year on capital you are contractually prohibited from ever giving back. Watch SCI do exactly this. As of the end of 2024, its Cemetery Perpetual Care Trust investments held about $2.15 billion. That portfolio runs roughly 59% equities, 27% fixed income, 10% alternatives, private equity, real estate, infrastructure. In 2024, those trusts returned 12.3%. In 2025, they returned 15.1%. The recognized income SCI pulled off its perpetual care trusts alone was $96.4 million in 2024 and $111.1 million in 2025. That cash is booked as cemetery revenue and spent covering the exact lawn mowing the fund exists to pay for. Whatever's left is yours. A permanent hedge fund whose depositors are, by design, dead. That's mechanism 2. Mechanism 3 is the float, and it may be the quietest theft of time in American commerce. It's called pre-need. You sell a plot and a full funeral to a healthy 55-year-old today, at today's price, paid in cash. They will not use it for 30 years. You take that cash and you invest it for 3 decades before you ever deliver a thing. SCI's pre-need backlog money collected now for services owed later stands at roughly $16 billion. $16 billion of other people's money working for you until the customer finally shows up in a hearse. Mechanism 4 is the merchandise, and it's the oldest markup in the trade. The vault, the marker, the bronze, the flowers, the opening and closing of the grave, each one sold at multiples of cost, at the one moment in a human life when nobody price shops. A family that just lost someone does not ask for a second quote on the casket. The industry knows this. The margin reflects it. Now the cost side, because the machine runs whether anyone dies this month or not, grounds, crews, water, mowers, fuel, the office staff, the property tax, the trustee fees. A mid-sized cemetery might spend a few $100,000 a year keeping the lawn green and the roads open. That cost is fixed. It does not care about your sales. And here is the structural trap the old family owners always fall into. They sell the plots, spend the cash, and leave a maintenance obligation that lasts forever against a trust that was underfunded from day one. You can't put a cemetery on pause. The grass grows in a recession. The grass grows when nobody's buying. If the trust wasn't fed properly for 50 years, the mowing bill outlives the money, and the whole thing rots literally from neglect. Which brings us to the shadow file. Because when a business is built on selling more plots than the ground can politely hold, there is a temptation baked into the arithmetic. Sometimes the temptation wins. Look at one name, Menorah Gardens. 2 cemeteries in Florida, Southwest Ranches in Broward County and West Palm Beach, both owned by SCI. Starting in December 2001, families sued. The allegations, later documented in court and in the press, were these: to make room for new burials, in ground that had been oversold, employees dug up existing remains, broke open the burial vaults, stacked bodies where families had paid for side-by-side graves, and discarded human remains in the woods behind the property. Bones were found in a dump pile. According to Associated Press reporting, the company first said they were animal bones. DNA testing said otherwise. The cemetery manager, Peter Hartman, killed himself when the story broke. In May 2003, the Florida Attorney General settled a civil suit under which SCI agreed to pay up to $14 million in fines and restitution. Criminal charges, third-degree felonies for negligent operation, were filed against the company and its Florida subsidiary. In December 2003, before Circuit Judge Leonard Fleet, SCI settled the class action brought by roughly 2,000 families for $100 million. Around 9,000 people eventually filed claims against that settlement. In 2007, the company admitted its employees had tampered with the graves. This was not a one-cemetery problem. At Eden Memorial Park near Los Angeles, another SCI property, the company paid a $35.2 million settlement in 2014 over allegations that groundskeepers broke vaults and threw the spilled remains into a dump on the premises. Then it was sued again in 2015. Same allegations. The reframe writes itself when the density model meets its own incentive. State the numbers and move on. So how does this business die? The first threat comes from inside the product, and it's on fire. Cremation. It is cheap, it is fast, and it uses almost no land. SCI's own filings put its cremation rate above 56%. Every cremation is a customer who does not buy a $3,000 plot, does not need a vault, does not feed the Perpetual Care Trust. The density machine only works if people keep choosing the ground. Fewer are. The second threat comes from outside, the trust itself and the regulator watching it. A Perpetual Care Fund invested 59% in equities is exposed to every market it holds. A long enough downturn, and the yield that pays the mowing bill shrinks below the mowing bill. Add a state that tightens funding rules or audits the trustee, and the free capital game gets a lot less free. The fund that could never be withdrawn can still, quietly, fall short. Now the verdict, in 2 sentences. A corporate cemetery does not sell you land, or maintenance, or peace. It sells the right to run a permanent bank, funded by involuntary deposits from people who are legally forbidden because they are dead from ever asking for their money back. And it is not a niche opinion. It's a $4.19 billion public company with $2.15 billion in care trusts, a $16 billion pre-need book, and roughly $18.6 billion in total assets, trading every day on the New York Stock Exchange. Wall Street already bought the thesis. It's called SCI. Time to pull it all together and answer the actual question. How much money do you make if you do this right? Let's run the math on 3 realistic versions of your acre. Option 1. Build a residential subdivision. You buy the land, fight the zoning board, build the houses, and sell them once. Say $30 million in home sales against $24 million in land and construction, $6 million in profit, and the day the last house closes, your revenue is zero. You sold the ground one time. Option 2, buy a commercial office building, $10 million in. You collect rent from corporate tenants, maybe $1 million a year gross, minus taxes, minus upkeep, minus the depreciation eating your books. Then a recession empties 3 floors and your cash flow inverts. You own vacancy risk with a mortgage attached. Option 3, acquire a private corporate cemetery. You take 1 acre of ground bought for $10,000, divide it into 1,100 plots, sell them double depth for more than $3 million, lock the mandated slice into a tax-advantaged perpetual care trust, and spend the next century running a multi-million-dollar investment fund whose clients are mathematically guaranteed never to withdraw a cent. The plot sale is the one-time revenue, the trust is the annuity, the pre-need book is the float. You don't sell the acre once, you sell it 1,000 times and then you get paid forever to mow it.